Hello, everyone. Welcome to our 2023 Midyear Outlook. Hope you enjoy it.
Hey everyone, we're back with our mid-year outlook for 2023. Just a quick recap. In January, we told you we believe stocks would be positive this year, as the market is rarely down 2 years in a row, and that the bond market was far more attractive than years past. So far, so good. Here's what we think the rest of 2023 may have in store. Inflation has fallen now 12 straight months, with last month's CPI coming in at 3%. That's down from its peak of 9.1% last June. Overall, the cost of goods and services is still high. But what we've seen is a really resilient economy that just keeps moving forward. Last week, Q2 GDP exceeded expectations, and with continued low unemployment, it's no wonder the stock market has really bounced back in 2023. It's also been a strong start for Q2 corporate earnings so far, as we continue to see solid revenue growth and stable profit margins, which suggests positive news for stocks. We also believe that we're nearing the end of the Federal Reserve's rate hiking campaign. Even though the Fed hiked interest rates another quarter percentage point last week, Fed Chairman Powell took a more dovish tone in his press conference, acknowledging for the first time that the Fed is open to cutting interest rates when inflation is under control. Definitely a positive sign for the path of interest rates going forward. And if we do see rate cuts in the second half of this year, we believe that would bode well for the equities markets. Here are a few stock market indicators that point towards positive returns. One that's interesting, the S&P 500 officially entered a bull market in June. Forward returns after a bull market is confirmed have been historically strong, with the S&P 500 posting an average gain of 18.9% 12 months after the index qualified as a new bull market. Given last week's interest rate hike, U.S. interest rates have reached their highest levels since the early 2000s, with the Fed funds rate range currently between 5.25% and 5.5%. As mentioned, we do believe the Fed will end its rate hiking campaign later this year, which should have a positive effect on the bond market. Looking at past market history, once the Fed is done raising interest rates, Treasury yields have declined and bond prices have increased. Remember, when interest rates decline, that's typically good for existing bond values and what tends to result in a positive scenario for fixed income investors. Given the hawkish Fed mandate, short-term bond yields are quite attractive compared to the past 10 years. Yields are now much higher than previous years, which should provide a tailwind for fixed income returns going forward.
Thank you for watching our Midyear Outlook. On behalf of everyone here at Platana Financial, we wish you a great rest of the summer. If you have any questions or need anything from any of us, please don't hesitate to call. Take care now.
Please take a moment to review these important disclosures.